Hello, everyone. Today on the Final Bar, happy Fed Day. We'll be talking with Dana Lyons from J Lyons Fund Management. We'll get his take on what we're hearing and the longer term trends on a day like today. It's so easy to get caught up in the flickering ticks, the short termism that happens on a Fed Day. It's all about the longer term trends. If you really want to understand the story about 2022, it's how those short term flickers, those short term movements to the upside and the downside net into a trend which remains to the downside. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. I actually had to glance out the window to see the weather because I've focused on the Fed, on the movements in the market. That tells you what sort of engaging day we've had. Some days are easy. Some days are pretty light in terms of the information flow. Today was sort of the opposite with a lot of things happening. We're here to try to help keep you on the right side of things mentally and with your portfolio, with your head and with your portfolio, hopefully in the at the same time. A lot of choppiness today, certainly a bounce in the afternoon after around 2:30, down a bit after the 2 o'clock announcement on a 75 basis point rate hike, but then a nice bounce during the press conference. The only reason why I'm not ecstatically telling you this is the bottom is in and we need to start rallying from here, it's because we've seen this pretty much every Fed meeting in 2022, even when they've been hiking rates. You get the bounce. And I think a lot of that most likely because of the language in the press conference where we're told, we got it, we're on top of things, everything's going to be great, no problem. The reality of what higher rates and higher inflation, continued inflation, higher oil prices, all of that is what continues to push the markets to the downside. We'll look at the charts and how today's movement relates to the long-term trends, how it's impacted the charts here in a little while. We have great guests on the show. I'm excited to talk to Dana Lyons here in a little while. Always has a great perspective to help us make sense of things. Tomorrow on Thursday, the 16th, we have Cliff Droke joining us from Cabot Wealth. Cliff focuses on gold and materials parts of the market. And I'm very interested to hear his take. Gold is usually thought of as a pretty decent inflation hedge. It's not been a great one in 2022, mainly because of the strength of the dollar, among other things. But I'd like to hear Cliff's take on that space and what to expect going forward. The next 3 days, on Friday and the next week on Monday and Tuesday, I will be off with my family in Eastern Washington, and we've got some great special content we've prepared for you. We're going to talk about how to use trend lines more effectively, how to learn the lessons of market history. Great thing to review, given all the stuff that's happening right now in terms of a bear market phase, and how to relate names to one to another. So all of that coming up over the next week on StockCharts TV on the Final Bar. Also, just so you know, next week, I'll be giving a presentation for the Money Show Virtual Expo. I will be talking about the most important chart of the day, basically how you start your investment process every trading day. I would argue has a big impact on your decision-making through the course of the day. I will talk to you about what that chart is, what it should be, and how to use it among other inputs to make a well-defined investment process using the best practices of technical analysis. Go to moneyshow.com, by the way, if you want to sign up for that event next week. Let's continue on today's show with our market recap. Let's talk about what Fed Day what has happened here on Fed Day. We're going to do a segment a little later called Don't Fight the Fed. We're focusing a little more detail on this meeting relative to other meetings, some of the expectations going forward. But let's just look at the action that we saw today. The S&P closing up about 1.5%, chopped around quite a bit, came off in the last 30 minutes and just below 37.90. The NASDAQ Composite and the NASDAQ 100 both up about 2.5%. Leading the other major indexes, mid caps and small caps up as well, but large caps were the leading the way higher. The VIX back below 30, around 29.34, coming off after yesterday's bounce to the upside. Interest rates ended up chopping around quite a bit during the course of the day, but finished off a little lower than we saw yesterday. 10-year yields around 3.40, 30-year yield just a little bit above that. So a choppy movement to the fixed income markets, again, all around the the Powell press conference and the Fed meeting release. At the end of the day, not a lot of movement from 2 p.m. to the end of the day on interest rates, to be completely honest with you. Commodities overall a bit stronger, although they came off in the afternoon with the DBC finishing about flat for the day. Gold and silver both higher. Crude oil prices a bit lower. The USO was down 1.7%. Cryptocurrencies continuing to feel some serious pain. Bitcoin almost got to 20,000 overnight after being around 22,000 yesterday as we were recording the show. We've actually round tripped back to just below 22,000 now, and the Ether is below 1,200. So talk about coming off of pretty significant roll off over the last certainly the last week or so. After chopping around and stagnating for Bitcoin around the 30,000 level for quite some time, rotating to the downside. Let's look at a chart of the S&P 500 to talk about what we're seeing here. So, if you look at the bounce today, you had Monday's session lower pretty significantly. That was after Thursday, Friday last week gapping lower. Monday gapping even further, getting below 3,800 there for the first time in about a year. Then we have yesterday, another further close today, a bit of a move back higher. But again, we're all settling in within the range of Monday's session. Reminds me of what we saw a couple of weeks ago. We had the big move higher to above 4,100. We got above that first Fibonacci retracement level around 4,125, stalled out around 4,150. Then for the next week and a half, it was a sideways market. You had up days and down days, but you never really gained any ground on either side of the coin. At the end of the day, we were sort of chopping around equilibrium for the S&P before we resolved to the downside. It's a little too early to determine that is what we are seeing here. But remember, even with the nice move, with all the green on the dashboard today, that's all very exciting coming after yesterday's new closing low for the year. But let's just keep a proper time frame or proper perspective here. We're still below where we started the week, right? I mean, we're still down a little bit for the week. So let's make sure we think about trend. I often tell people in this sort of environment, I find a lot of people focus way too much on price levels as a key important input as opposed to trend. Look at the charts over time. Look at the trends. The trend is decidedly down. And even today's bounce doesn't even touch the downtrend that we've been in. We're at the lower end of a channel, which has been evolving for the last 6 months. Let's remember that as we're thinking about today relative to the overall context here. To finish off our market recap, looking at sectors, I was doing an interview earlier today with David Chung at Investors Business Daily. We had a great conversation about a number of different things. One of the things we were talking about was leadership coming out of bear market phases, right? When you actually have a bear market bottom, what tends to work afterwards? And it's usually some of the growthier stuff, things like technology, consumer discretionary are the ones I would think of as sort of the general leaderships at a market bottom as things start to improve. And then the other stuff starts to catch up on average after things start to improve a little bit. So interesting to see consumer discretionary number 1 today, technology number 4, both up over 2%. Is that enough to tell me that a bottom is in? Absolutely not, right? Again, this is a bounce off of fairly beaten down levels. What would amaze me is if the market does not bounce like this after such a sell-off as we've seen in the last week. That's actually a pretty normal reaction. Anytime the market moves significantly in one direction, at some point it'll happen so quickly and so severely that contrarians will come in and bet on the opposite. And that's what causes that quick reversal. At the end of the day, those little swings turn into longer term trends. And that's where we want to focus on the long term, I would argue, still bear market phase that we remain in. Looking at a couple individual names, some of these things that are up, Boeing is one near and dear to our hearts here in Redmond, Washington, because they're located not too far from where we're doing the show here today. But again, coming off of a new swing low, you need to see it get above 140, a new swing high, to be anything but still fairly negative on it. Netflix as well. When I'm looking at the chart of Netflix, what strikes me is not the bounce today, but just these gaps lower, right? I mean, the quarterly gap lower that we've seen really since November of last year, that has sort of been one of the exclamation points on this downtrend. The fact that rallies have failed to even reach or eclipse the 50-day moving average. That's a stock in a downtrend. But now look at what's happened, right? We put a low around, we'll call it 165 or so from the low in May. We've touched that again this week and now bounced off support a little bit. So it was a bullish candle pattern here called a bullish piercing line. If you know your candle patterns, nothing really like that this week, but certainly a brief, at the very least, a brief bounce off of there. So one of two things has to happen, right? We either make a new low which would confirm yet again that the downtrend is very much in play. Or we make a new swing high, we get above 200. Even better, we get above the 50-day moving average finally after being below it for about 6 months now. Until those things happen, I think the path of least resistance from a technical perspective still tells you it's lower. But now we're sort of in that question mark period, right? Where we've now tested support and bounced. That's now a valid support level. The momentum is higher than it was back here in April, May. That's when Netflix was selling off on very oversold conditions. Now we're not reaching an oversold condition as we retest the lows. That could be setting up for a bit of a bounce. So what it's telling you now is it's not going down anymore. It's not telling you that things are turning encouraged just yet. Getting above 200, I think, would be a good way of potentially validating that bounce to the upside. Just to finish off, some of the groups that are doing better today: automobiles, renewable energy equipment, aerospace is Boeing's group. Renewable energy equipment, that's things like Plug Power, Enphase. These are names that we've talked about before. And again, encouraging that you're seeing some bounce off of there. For Enphase in particular, it's finding support at its 200-day moving average. It's really been sideways for quite some time. Talk about a lack of directional conviction in a chart. This is going the painful third direction of sideways. You need to see this break out of that congestion range, either make new highs or make new lows. That tells you when one side, buyers or sellers, are starting to take control. Let's take a quick commercial break. We'll be back with today's guest, Dana Lyons. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close as we focus on these markets using the best practices of technical analysis and the technical toolkit. A couple quick announcements before we get to today's guest, Dana Lyons. First off, we welcome your questions. We'll do a mailbag segment actually into next week, but we would love to hear from you and hope to feature one of your questions in our next mailbag segment. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air in our next mailbag segment. Also, go to StockChartsTV.com. That's our on-demand platform. Larry Williams posted his most recent market update just in the last week or two, which is featured there. We have our latest episode of The Pitch, which we'll be releasing tomorrow. A lot of great content to help nudge your thinking and help you make sense of these markets in uncertain times. It is for free for your enjoyment at StockChartsTV.com, or on your mobile device, just search for Stock Charts TV on demand. I want to welcome on today's guest, Dana Lyons, joining us on the show once again. Dana is the portfolio manager at J Lyons Fund Management, editor of the Lyons Share Report. Dana, it's good to see you. Welcome back to the show.
Thanks, Dave. Always good to be with you. Thank you.
So Fed Day, obviously a lot of things to think about and a lot of things to digest. As usual, you've brought some good long-term charts, which I think is so helpful to try and navigate these sort of choppy periods. Start us with chart number one. What are you seeing here?
Sure, and I agree with you, especially in volatile times like this. It's a good idea to take kind of a step back and get a picture of the overall trend and the overall risk, pretty much status. And this chart is it's what we call a background indicator. It gives you a picture of the overall risk situation in the longer term market trend and longer term cycle. It's not a timing indicator. It's not an actual indicator, but it gives you a sense of where we are in the long term cycle and the overall risk picture. So it shows you the percentage of household assets which are invested in stocks. And as you can see in the blue line on the far right, we're just off, after this past quarter, we're just off all-time highs in terms of household assets and stocks, just off of over 40%, and that even eclipsed the 2000 top. And the red line shows the forward 10-year return in the S&P 500 annualized. I should point out that the scale is inverted. So like any other investor sentiment type of a metric, the correlation is usually inverted. So the more people are invested in stocks, the more bullish people become, the worse the forward returns are. And you can see that has historically been the case since the start of the series back in 1950. You saw back in when the series topped out in 1968, and then again in 2000, forward 10-year returns were actually negative. And if you extrapolate to where we are now, certainly we could be well into negative territory over the next 10 years in the S&P, if history is to be any guide.
Dark clouds. Watching this chart as you're talking about the overall, potential headwinds then for market growth. Chart number 2, interest rates. Obviously, a big story today with the Fed. Talk us through what you're seeing in terms of upside potential for the 10-year.
Sure. Now, this is another long-term kind of perspective, but it's also an actionable one. So rates have been obviously spiking, 10-year yield up again over the last week substantially. So people are wondering, where's it going to stop? It certainly has contextual implications for mortgages and what people are doing with the homes and whatnot. So from a longer term perspective, dating back to the top in 1981, we're seeing some pretty significant potential resistance just above 4%. So in this current climb, that might be a logical spot to expect at least a pause. I would also note that in the long term cycle of interest rates, so there's a lot of consistent 60-year cycles, and we think that bottom in 2020. If that's the case, then we're going up. Generally, interest rates are going up for several years, so actually several decades to come would be our guess. But it's never a straight line. So just above 4% might be a spot to expect a pause in the initial spike higher off of the lows.
It's fascinating to me as you're showing this chart, and I remember when 10-year yield is below 1%, you suggest that a 10-year yield could go to 1.5–2%. That seemed an absolute moonshot, unrealistic upside target. Look at how you're absolutely right that there's certainly opportunity for yields to go much higher than they've been in quite some time. If that is the environment we're looking for, how would you coach people to navigate through this period? We're going from a period most people are fairly comfortable with, which is a period of falling rates, the strength in growth stocks. Now, all of a sudden, this would feel like a very different market. Where do you look now? How do you ride out the remainder of 2022 if this assumption proves true?
In terms of 2022, I would look for, you mentioned there's in your intro that, we had a nice day today. Is there any evidence that the long-term trend is turning higher? At least the trend in stocks and risk assets is turning higher. I would say no, that we don't have any evidence of that yet. Same thing with interest rates. 4% would be our upside target. We're still climbing. Is there any evidence that the rise in rates is slowing down? I would say no. If I can add in the big picture, tying both charts together, I would say I think investors should have a different perspective in terms of their expectations for both returns and risk assets based on what we've seen, versus what we've seen in recent years where stocks, V-bottom every time and they go straight up. I think they should temper those expectations. And the same thing with bonds. Bonds have been, rallying obviously for 40 years. If the long-term trend turn is at hand, and you can see the trend line was broken since 1981, then people should probably temper those expectations regarding, expected bond returns. And I should also point out in terms of their expected view of bonds as a conservative instrument. Bonds in their lifetime have always made money. If bond yields are going up for several decades to come, that doesn't equate to a conservative type of investment as far as I'm concerned. So I would say if I can add one final point, in that type of environment where stocks are challenging, bonds are challenging, it becomes and no moves will be straight up or straight down, but it becomes extremely important, I think, to either adopt the strategy or find a manager with a very active risk managed strategy that can help you with timing, when to get in, when risk is appropriate to be invested and aggressively invested, but just as importantly, or more importantly, when to be out of risk assets, out of the stocks, even out of bonds at times, because I think preservation of capital is going to be much more important than any type of capital appreciation or reaching for appreciation over the next maybe even decades to come.
Capital preservation. That might be a phrase we hear a lot more here in the coming months and years. Dana, it's great to see you. Listen, thanks for giving us perspective on a day like this. Stay safe there, and we'll talk to you again soon.
Thanks a lot, Dave. Take care.
That's Dana Lyons. Dana's a portfolio manager at J. Lyons Fund Management, editor of the Lyons Share Report. He had so many great nuggets of investment wisdom there at the end. I wish we could have dug into a lot of that in a lot more detail. His comments at the end, I mean, I think in terms of changing our expectations, managing our own expectations, I think is spot on, particularly if you're newer to investing. You've learned how to invest during a period of strong growth, of low rates, unprecedented support from the Fed. 2022 is more of a wake-up call. A lot of bad habits can be accepted in a bull market phase. Bear markets, all the little ugliness starts to come out in your investment process. So a great time to upgrade your thinking and manage your expectations. Great take there from Dana Lyons. Let's continue on with this segment. Don't fight the Fed. We mentioned, obviously, we've talked for most of the show here about just what's happening today. I thought Dana did a great job sort of giving us some longer term context and really the upside potential in rates. I still find a lot of people asking questions about how high rates can go, implying that haven't they gone up enough? And if you've not caught on yet, the language you heard from Chairman Powell today in the press conference, any of the language I've heard is that in a lot of ways, this is just the beginning. This is a process of changing Fed policy, what they call is becoming much more hawkish as opposed to the dovish policy, very accommodative policy in 2021. 2022 is more of a very different take on things. And you have to understand the uptrend that has come driven by the Fed supporting risk assets that now is kind of off the table. So let's look at a chart of the S&P 500. Just think a little bit about what happens around Fed days. I get a lot of course, short-term questions talking about, what do you think is going to happen before the Fed announcement, after the Fed announcement? My initial reaction, my initial comment to any interview along this topic is, listen, a lot of that is noise, right? You can't draw a lot of conclusion because of the Fed, because people are literally reacting to individual words, and it's a very fickle, short-term, noisy sort of tape. At the end of the day, it's what investors are pricing in terms of the reality of those expectations. Inflationary pressures, higher prices for goods, higher energy prices, it costs more to travel and to do things. That impacts, and the impact that you're going to see on the consumer is relatively immediate, right? If you go to buy a house in the next couple of weeks, you'll start to feel that it's getting more expensive to do so. And that has a real implication for consumers. The impact on companies and on the economy is what can be a little more harder to anticipate, because that's what strategists are trying to price in and money managers are trying to price in well down the road. But let's look at what has happened actually just year to date. So this is our fourth Fed meeting of the year. The first one, we're looking at a daily chart of the S&P 500 here. See if you can detect a pattern in terms of what has been happening leading into a Fed announcement and coming out of the Fed announcement. Here was the first meeting, which is that last week in January. That was the the last discussion when we had been talking about raising rates. This is when it actually started to become real, and we started to have more of a time frame and specifics on it. So what happened here? A lot of choppiness, but a nice rally over the next week or so. That ended up being the end of that bounce before the next leg lower. We made a new low in late February. We then had the second meeting, March 15th, 16th, which is sort of right in the middle of this month. You can see the nice bounce higher. The bounce higher actually continued for about 2 weeks. From there, we attempted to make a new high. The NASDAQ actually did a little bit better, making a new swing high. Some individual stocks, like NVIDIA, I remember jumping above its high from February. Felt like things potentially were giving an all clear. Of course, that was not the case. No follow through previous resistance, and we rolled over the next big leg down into the low in mid-May. That brings us to our previous Fed meeting, which is actually here. A little bit of a different, bit of a different take, but you see this big spike here, which, if I remember right, was Fed Day. Right after that, the market turned again and went lower. So pretty much every time on Fed, you've had a nice rally jumping around. A lot of volatility, a lot of volume at the end, kind of netting up to some short-term optimism. In all of those times, the market has in the end concluded that the larger downturn is in play. Two of those saw some decent bounces, and this last one here in May, turned lower again very, very quickly and made a new low for the year within a week of the Fed meeting. Brings us to where we're at today, right? You have the rally off of the lows, and again, let's not forget we're coming off of a new 52-week low, a new swing low for the S&P 500 over the last week. We've bounced a little bit today. At best, I would argue, given the fact that conditions, largely speaking, have not changed, right? All of the reasons why the Fed feels compelled to take aggressive actions like to raise rates 75 basis points are not gone. Those are still very much here. And as Powell mentioned, they're data driven, whatever that necessarily means. That means they've opened the door to do whatever they want in the next Fed meeting is how I would translate that. But that is trying to inject some sort of short-term optimism that they're on top of things. But at the end of the day, the trend over the last 6 to 8 months is telling you that conditions are not ideal for risk assets and certainly for growth stocks. I'm not seeing anything to suggest that might be different. What that tells me is, base case, I could see a bit of a bounce here, but overall, I don't think the low is in for 2022. Downside target for me is around 3,200. We'll see. There's a lot of game left between where we're at now. It's about 600 S&P points below where we're at. So a lot of things can happen between here and there. Let's let the charts tell us what the conclusions should be. That's our segment. Don't fight the Fed. Just trying to look at some of the performance around some of those previous Fed meetings. And again, usually a lot of noise on a day like this. What happens tomorrow and Friday is what's really, really important to pay attention to. We need to wrap the show, folks. Go to the 3 and 3. Let's talk about 3 charts in 3 minutes to tell the story of this market environment. And here is chart number 1. I wanted to start with Microsoft. If you look at the chart of Microsoft, what I like about this particular chart is the fact that the what we call a change of character. We talk when we're looking at the S&P 500 about what's called a change of character, where the trend is positive and then the trend becomes negative. What are the specifics that would tell us that there's been that rotation? Well, we've gone from higher highs to lower highs. We've gone from higher lows to lower lows. Instead of being above 2 upward sloping moving averages, we're below 2 downward sloping moving averages. But I wanted to focus on momentum. I mentioned talking with David Chung at IBD earlier today. We had a great conversation about a lot of different things, but this is one of the charts we looked at. Look at how the range in the RSI was fairly constructive for 2/3 of this chart in 2020, 2021, becoming overbought on rallies, remaining for the most part above 40 on pullbacks. Look at how that all changed in December, where we're sort of right around 50, and then we break below 40, and all of a sudden we're down in this range. On rallies, we're not getting above 60. On sell-offs, we can become oversold. This is a trend change. This is a change in momentum. This is a change in character. If you want to get excited about stocks and risk assets, if you think the major benchmarks have an opportunity for meaningful gains, you need charts like Microsoft to improve, not just one day, but a change in trend. And there's a lot more that I would need to see to declare that to be the case. Chart number 2 is the chart of Netflix. Again, what's interesting about the chart of Netflix, we talked about this briefly in our market recap. Bouncing off of support, that's encouraging. You had a bullish candle pattern here in early May. We had a bounce off of those levels for a couple of weeks. We've now retested the lows, and as of one day, have bounced higher and on higher momentum. That's encouraging as well. Oversold in April, not oversold so far in the month of June. One of two things happens on this chart. Either we fail to hold those support levels and break to new lows, or we break above 200. Let's wait to see which ones happens. The third one, Marathon Petroleum Corp, MPC, not quite to its 50-day moving average, but all the energy stocks down today. Can they hold the 50-day? That's a key level I would be looking for. Folks, that's a wrap for the show. I want a special thank you to Dana Lyons from Dana Lyons Fund Management joining us today, sharing his big picture perspective on a noisy Fed day. For StockCharts.com, I'm Dave Keller. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.